Well, nice to have you. We did this last October, I guess.
We did.
Here as well.
It's interesting. We're on a 6-month cadence now.
We
so
are.
It's good to see you.
Lots changed in
has.
those 6 months. So I guess the first question, given the conversation here, is how worried are you?
Not that worried, which is ironic because I grew up in the credit business where you're taught to be worried about everything. There's a lot to think about, a lot of uncertainty around the trajectory of rates, geopolitical instability. But the reason I'm not as worried as maybe some, we have the benefit in our business to have a look at 3,000 middle market assets across the globe. And at least as we sit here today, the numbers are coming through. Revenues are up, EBITDA's up, people are passing through price increases. Mood in the boardroom is quite good. So, I think there's a lot to think about going forward, but we're coming into this rate hike cycle with a lot more, what I would say, fundamental strength and buffer in the economy than I think we're used to seeing.
So to that point, again, credit deterioration, you're not seeing it.
Our credit portfolios are probably healthier than we've ever seen them in our 25 years.
So, all right, you walk around the halls here, not yet, but soon when it gets very crowded, it's still 7:30 in the morning. And a lot of people are being very concerned. Talk about a recession potentially, even as soon as later this year, but probably 2023 if it comes, given the Fed's move. But you're not seeing any of that in the underlying credit and or even your portfolio.
And I don't want to say, people's hair's on fire. Recessions happen. We've got people out calling probabilities of recession, but not really talking about magnitude. I think we got to deal with information as it comes and let things play out here. But back to our credit portfolios, we're coming into this at all-time high coverage rates. We're at all-time low loans to value. We're coming off of 20% plus cash flow growth in our middle market loan book. So there's just a lot of things that need to happen before we're talking about credit deterioration.
It's funny, on your conference call, I think it was just last week, you said the global search for reliable income continues unabated.
It does.
As investors continue to seek premium returns over liquid market equivalent with less volatility. You raised, $13.7 billion in gross capital just in the quarter. So explain that to people. What does that mean? What is pushing that?
This has been a decades-long trend, which is simply saying in a persistently low rate environment, everybody was looking for yield. That's true if you're a retiree who is living longer and trying to manage their lifestyle. It's true if you're a pension fund and you're trying to meet your actuarial payout requirements, a life insurance company. So over 20 years, I think the markets have discovered the value of yield and the value of compounding interest. When you look at the markets now, you're already seeing it in performance. The high-grade bond markets are getting, they're experiencing difficulty.
Yes.
High-yield bond market experiencing difficulty. Floating rate loan markets actually up high single digits. So now we're going to see a second phase of growth and flows into these markets as people pursue floating rate credit assets in the wake of the rate hikes.
Right. All right. But as the risk-free rate moves up overall, and does that search for yield in any way abate?
I don't think so. I think 20 years ago it may have, because the mindset of most investors was more total return oriented. I think what we and others like us have proven is there's excess yield available in the private markets. And so that excess yield actually floats along with the rise in the base rate. So almost counterintuitively, I think you may see more demand as long as that excess return persists. So as base rates go up, returns in floating rate assets go up, and you're still getting an excess relative to base rate.
Is there a number, though, at which sort of that dynamic changes if we were to get to 5%,
it's
say, in the 10-year?
I think there are certain investors, for example, insurance companies, that are truly matched, that when they get to a certain rate of return, they'll say, okay, I can meet my requirements. But at that point, you probably see other investors turn on who now see it as an opportunity to rotate out of other assets into it. So our experience has been there are puts and takes, but generally you should see continued flows.
Shepard Smith here. Thanks for watching CNBC on YouTube.